Hi, this is Jim Thomason of Bassett Software, and today I'm going to talk to you about adding in debts to Debtinator, finally. Spent the last couple of videos setting up the various support information required in the file, the bank accounts, income, expenses, and now we're actually going to get your debts into the system so we can start paying them off. Now, it's important that you fill in all the other information as well, because Debtinator needs all of it to get your full financial picture. There are other pieces of software out there that say that they'll handle paying down your debts by only typing in your debts, what you owe. But that's an incomplete picture because that requires you to know and figure out how much you want to send to them. And that'll work, but it's not efficient. If you give Debtinator your entire financial picture, it can use all of that information, work together to figure out a much more efficient strategy than you can figure out just looking at one single piece of information. So what we're going to do now is add in a couple of debts. The first step that I'm going to add in is my mortgage. Now, it's very important to remember that your mortgage is not an expense. It's a debt. It's money you owe. If you're staying in an apartment, rent is an expense because that's just something that you're paying to someone. But the mortgage is money that was loaned to you that you need to repay. So it's very important to add this in as a debt because this is something that you need to pay back. It's due every month on the 1st. We pay out our checking account. I have a 5.99% rate, no annual fee in this case. The outstanding balance is $100,000. And my minimum monthly payment, we're going to say, is $750. This, you can see now fills in my minimum payments for the next 30 days. It's not going to try to figure out how much you should be paying overage because it doesn't know which scenario you're using. So it's just going to tell you what the minimum is, and you have total outstanding debts of $100,000. I'm also going to add in, say that I have a car loan, also paid from checking. That's going to be due every month on the 15th. That is a 3.99% APR, outstanding balance of $10,000, and a payment of $350 a month. We'll say that I've got a couple of credit cards. The first one will make an easy one. We'll say that I have a Visa card. It's due every month on the 20th. It's got a very high rate of 14.99%, but fortunately a very low balance of $2,500, and I'm going to be required to pay $200 a month. Now, my second debt will make this one a little bit more interesting because everything so far has been very, very simple in what's due. We'll make this due on the 10th, but then we'll get into some details because Debtinator has a lot more power in terms of how it can structure its debts than what is normally presented to you. This screen here is called the simple view. This is because we wanted to make things simple. We didn't want to scare you away too quickly. But frankly, unfortunately, most debts are not simple. They tend to be complicated. So we also have a complex view. To get to it, you hit this little gear button down in the lower left. That gives you the option to switch to the complex view. You can also choose to always use the complex view or switch back to the simple view when it's available. That's just personal preference. Some people like to only stay in the complex view. Some people like to switch back and forth. Use whichever works for you. In this case, we're going to switch to the complex view. And that, as you can see, gives us a lot more options. Several of these are repeated from the previous screen, the simple screen. We've got the annual fee, which account we're paying from, the repeat rule, and so on. Then we've got a couple of additional things. We can specify a maximum payment on the debt. That's useful if you want to throttle something. For example, your mortgage. You may not, you can set up a scenario and pay down your debts in record time, but you might not actually want to pay down your mortgage. You might just want to ride that out for 30 years because you're getting that big a tax break on the interest from it. If that's the case, you can set the maximum payment there. At the other end of the spectrum, you can set an enforced payment. That says that no matter what, the debt must be paid a minimum amount per month. Why that's important, we'll come back to in a minute once we've explained line items. Now, each debt here is set up on the complex view can consist of multiple line items. Now, many debts are just going to have a single line item. Your mortgage will, a car loan will, and so on. But credit cards can have multiple line items on them. And the reason for that is typically balance transfers. So what we're going to do here is we're going to rename this line item to purchases to make it more clear, and we're going to say that there's $500 on it. And then we're going to set our rate down here is a fairly reasonable as far as credit cards go for this time of year, for this economy, 9.99%. And the minimum payment due every month, we're going to make that be the greater of either 2% or $25 plus the interest accrued. The interest accrued checkbox says, okay, just whatever interest was given on the debt has to be paid in addition to whatever the combination is of these two items. Again, in this case, it's the greater of the percentage or the monthly fee, but it could be the lesser of or the sum of. And as you can see up here, the next minimum payment adjusts to reflect. We'll leave it as the greater of. So we can also set up and say that we've got a balance transfer that we performed on this card. And we transferred over a balance of $5,000. And we got a pretty good rate on it. Our APR is only going to be 0%, but it's only going to be 0% for the next year. So we'll specify that starting on December 10th, 2010, our standard rate is 9.99%. That's what we're going to jump up to here as well. Likewise, we need to specify that the minimum payment's going to go up. For now, we'll say that the minimum payment is only going to be a very small $10 because they don't want you to worry about paying it off too quickly. But once 2010 hits, then it's going to be the same thing as the other one, the sum of the percentage, the monthly fee, and the interest accrued. Now, one thing to note here is that this is going to actually require that the debt be paid a minimum of $50 because the minimum fee is the sum of the line item minimum fees, and each one is not going to drop below $25. If we wanted the debt's minimum payment to be $25 at most, instead we would set this to be $25, to just 2% of the balance plus the interest accrued. Here as well, 2% plus the interest accrued, and then we would set an enforced payment of $25. That says, okay, no matter what the line items tell us, make it $25 regardless. Pay the line items. When you make a payment to your debt, you usually don't get to choose which of the line items are paid off, and the bank, unfortunately, usually does that for you. 99 times out of 100 or more than that, you're going to end up paying the lowest interest rate first. Which means in this case, as we send payments to this debt, we're actually going to be sending money towards this $5,000 at 0%. We'd love to send money to the $500 that's at 9.99%, but it's blocked by this debt at a lower interest rate. That's why you've always got to be very careful with balance transfers. They're good to take advantage of, but you really can't use the card once you do. Because if you continue to use the card, then you're going to end up accruing debts at your higher normal purchases rate, but it's going to be blocked behind this balance transfer. So it's going to sit there and accrue interest at a much faster rate, and there's really nothing you can do about it. If you're a lucky person, you may be able to set it to something else, but chances are it's going to be the lowest interest rate. You can also choose to pay this bill on the most recent payday, same as you could with expenses. That just maps it and says, okay, this is actually due on the 10th, but if I have a payday that occurs right before it, then I'll use that instead. In the case of our sample file, I would be next getting paid on December 5th, so this bill would get paid on December 5th. Now we can go over here. In addition to our line items, we have a couple of advanced options we can choose. We can set an escrow amount, which doesn't apply for credit cards, but for your mortgage, you may be using escrow. If that's the case, fill it in here. But for our credit cards, what we are using is they're revolving accounts. So we're going to check that off and say it's a revolving account and say it has a credit limit of $10,000. And we've also got a grace billing period of 1 month. So, any charges we make, assuming we have no balance, as long as we've got them paid off within the first month, we won't actually accrue any interest. But any purchases we make get applied to the purchases line item. We're also going to go back over here to our Visa, and we're going to do the same thing. We're going to specify that is also a revolving card. It has a limit of $7,500, 1 grace billing period, and it just applies to whatever the default line item was. Now, the advantage to flagging these things as credit cards is we can then go to expenses if we wanted to, and those are now available as payment sources. Further, we can also go over to our ledger, and we can see that they now show up as options here as well to record transactions against. But that's about all the information that you need right now to get your debt set up in the system. Thank you very much for listening, and next time we'll learn how you can actually use all this information to get those debts paid off quickly. Thank you.